Well, we've arrived at the end point of the Global Tactical Asset Allocation and Stock Selection course. And I guess this is my opportunity to try to draw the course together in a short clip. So let me try to do that. There's certain takeaways from the course. And perhaps the most fundamental one has to do with the notion of market efficiency. That I hope that we have kind of a broader understanding of what it means in terms of relative efficiency. That some statement that markets are efficient or markets are inefficient doesn't mean anything. The real question is how efficient or how inefficient. So we know that the US markets are perhaps the most efficient in the world in terms of information being incorporated quickly and accurately into asset prices. But they are still inefficient. All markets are inefficient because it's almost impossible for information to be immediately reflected in asset prices and correctly reflected. So it's a question of how inefficient these markets actually are. Now, a lot of this course has to do with asset allocation. And in asset allocation, we kind of looked at two main views. One view is the strategic view, where we've got some sort of benchmark. And then we're going to take a strategic tilt in one direction, depending upon our view of the prospects, let's say over 5 or 10 years. The strategic asset allocation will be different from the benchmark, and it reflects our long-term bets that are hopefully based on sound economic analysis for certain sectors. Next, we looked at tactical asset allocation. And here's where we're doing short-term forecasting of asset classes. Short-term forecasting of returns, volatilities, and correlations. And here, we will take tilts or overweighting and underweighting that take us away from our strategic asset allocation weights. And by doing this market timing, we hope to add extra performance. So earlier on, I talked about sources of alpha. Well, one source is kind of the longer-term posture. Another source is kind of the short-term overweighting and underweighting. And the third source has to do with our selection of individual assets. And we spend a lot of time talking about methodologies for stock selection. It is almost surely the case that the stocks that we actually select are going to look different than the actual benchmarks that we're using for forecasting. So what do we do there? It seems inconsistent. We're using some sort of benchmark index like the MSCI UK to forecast the UK. And then we're taking a tactical overweight, for example, of the UK. Yet, if I've got $100 million to invest in the UK, I'm surely not going to invest in exactly the stocks that are in the benchmark. I can do better than that with the methodologies that we laid down in the course. So there's an inconsistency between the top-down and the bottom-up. And really what we have to do here to be consistent is to use the bottom-up in terms of building our bottom-up portfolio and looking at its expected returns and volatility and its correlation with other bottom-up portfolios in terms of our top-down asset allocation. So let me be clear by reemphasizing this, that the tactical models, our forecasting models, are often built on benchmark indices like MSCI indices. And then we decide to overweight or underweight based upon those indices. But what if we don't invest in those indices? What if we can get 1% better in terms of our stock selection if we do it ourselves, then what I suggest is that we need to incorporate that 1% into our forecasting models, and indeed into our strategic asset allocation. So we have to be consistent in what we actually do. Now, ideally, we would like a one-step process where we look not at a tactical top-down asset allocation and then a bottom-up asset allocation. Why can't we just select the best stocks in the world in one step? And that's almost never done. And the reason that it's never done is that people have a lot of problems in looking at characteristics and treating them equally across different countries. Well, in this course, we talked about attribute adjustment. So it is possible for us to do stock by stock attribute adjustment across all of the stocks in the world and run one giant stock selection. Now, it turns out that we need to be a little careful here in that we might want to put on some extra constraints in our selection exercise to make sure that we participate in countries. But it's real clear that the stock selection implemented on the global basis with adjusted attributes will deliver the best prospects in the world. Now, when I say constraints, these are logical because if all of the stocks that we select are, for example, reside in India, that's not going to deliver a diversified world portfolio. So it might be that we actually have to force participation from many different countries. But in theory, this is feasible to do for the first time, and it's critically dependent upon our actual attribute adjustment. So we've kind of done a lot of things. Asset allocation, both strategic and tactical. We've talked even about indexing. We've talked about tracking error. We've talked about characteristics and asset pricing. We've talked about adjusting attributes, not just for the performance within a country, but for a global program of stock selection. And we've talked about market efficiency and what it actually means. And it all comes down, in the end, to the following: that the financial world is incredibly complex and becomes more complex every day. The traditional methods of investing just cannot be in play in the next 5 years. We need highly rigorous, economically motivated, quantitative tools to assist us in filtering a very diverse set of information. The skill of the asset manager is going to be in evaluating a lot of these models and choosing the best model. We have emphasized over and over in this course that the model should not just be chosen on goodness of fit or R-squared. There are other considerations. A high R-squared model could lead to high turnover and be a losing model. The high R-squared model could be overfit. What we're really looking for is stability, consistent outperformance. And we're willing to sacrifice some predictability to get that stability. That's going to be of paramount importance. The other thing is that what we hope to do is to be smarter than the market on average. And I think that everybody in this course has the capability of actually doing that. But you need to realize that people figure out what you're doing, and you need to be prepared for that. So what works great this year in 3 years might not work because people learn. That means that you need to be doing research on the next generation of models, just as you're implementing your first generation of models. Research is of critical importance. You always have to have a new generation of trading systems ready to go, because at some point people will learn or basically follow your trades. They will see it becomes so difficult to hide your actual trades. People will know it's you. People know you're successful. So research is obviously very important for this. A rigorous discipline. The very first time we talked about a set of rules that we use, a protocol, a research protocol that ensures that we use sufficient rigor in developing these models to maximize the chance that they actually perform in the other sample period. All of this put together are ingredients. The quantitative model doesn't replace the asset manager. It might reduce the need for a crew of financial analysts. The quantitative model, the quantitative techniques in this course, what they do is help the asset manager take complex information, simplify it, and come up with good recommendations. The financial analyst is still used. The financial analyst takes a look at the list of securities that the model recommends to buy or the model recommends to sell and has input on that. But it's not the case that we've got a financial analyst looking at this stock and some other one looking at another stock and then coming up with recommendations that are based upon different criteria. We have a consistent model, consistent criteria, and something that's been validated on an out-of-sample basis. So all of this is designed to help. It's not yet the stage where we've got computer battling computer in terms of asset management. The human factor is very important. And hopefully with the tools in this course, it will help you be the successful asset manager.